Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, April 17th, 2026. S&P 500 currently sitting at 7130. I'm David Zarling here with Ian McMillan. S&P new all-time highs, probably not the only one. Not too shabby.
Not too shabby. Hey, no one ever got poor reaching all new all-time highs.
Yeah.
You could, in theory, if you were betting against the market.
That's true. But new all-time highs, probably one of the more bullish developments you can have.
Just the S&P? Anything else?
Yeah, not just S&P, right?
NASDAQ? Did Russell get there?
NASDAQ 100, small caps, Russell 2000.
Russell did get there, huh?
Yep.
Yeah, look at that. Well, I guess that's that.
Emerging markets also. Yeah, I guess yep. End of podcast.
Downtrend correction is over. It wasn't even I don't even think we got 10%, did we?
Nope. And markets doing abnormal things normally. I mean, one of the fastest 11 or 12-day moves we've seen. And isn't that fascinating that we could have such an aggressive move higher, back above a 200-day last week, April 8th being that big gap, and over the 200-day, obviously our clients are familiar that we repositioned back into exposure. But even since then, just an impressive move, 11, 12 days straight. I mean, in some sense, it almost feels like it's coming off of a major low, like something you'd see after a 20% correction.
Yeah, like a tariff tantrum or COVID. It's definitely a V bottom.
Well, we get to call it that now, right? You don't.
Yeah, you do get to call it now that we're at all-time highs. It could fail, but it's still a V bottom.
Right. What do you think about these V bottoms?
Terrible. I wish I could, if I could pay money to not have to deal with them, I would. like pest control.
Well, it's kind of been the standard operating procedure since 2018, with the exception of, I think we were talking before we hopped on here.
Yeah, 2022 was, 9-month downtrend. I mean, even that had some sharp. But yeah, I would go back to, so you could say, obviously, Q4 2018, I would say. We had Volmageddon early that year. I don't know if I'd really put that in the V bottom category.
I think you brought up an important concept there, because if we were to make an argument of market characteristic change and when that change started, Volmageddon would be it. I'm not saying necessarily the bottom in the first part of the year, but since Volmageddon, it's all been V bottoms with the exception of the 2022 bottoming process. Is that fair?
What do you think causes that?
Well, you get the non-sexy answer, which is more selling than buying. And do you get selling exhaustion? Or I would make the argument that the selling and the hedging, or the put buying, and that all that is future buyers. So you get these sharp reversals because everybody's trying to short the crap out of the market. And once it goes against you, you turn into a buyer. You have to cover. You have to close your position, which makes you a buyer. And we've said how many times on this podcast, really when we should be getting nervous is when they stop shorting. So if we have another corrective period and they stop shorting, stop buying put, stop hedging, that's probably when we should get nervous.
Do you think that there's easier access to shorting now? There's just more tools?
Yeah, more tools, more information flow. You have T+1, T+0, like settlement. That's much different. Market likes to make the fool out of the most. Moves like this, like even this current scenario, you go from a 7% correction to all-time highs in 11 days. If you're an active manager, if you're managing risk and you de-risked.
I did do that.
Which we did, yeah. And we've been back in since clearing that 200 days on April 8th. It participated, but do most make that shift that quickly? And so if the market's in the business of making it the most uncomfortable for the most investors, V-bottoms is one of those things. Now, I also recognize the BTFD movement, the buy the freaking dip movement, and you wonder when that ends. Like, there will be a day where that ends. It's just not yet.
Definitely a tough move, right? You had the gap. The gap was tough. I say that in the context of if you're using the 200-day as some type of pivot, which we do. Again, it's not, we aren't going from fully invested to 100% cash on the 200-day, right? It dwindles down to the 200-day, and then kind of the last little what's ever left is sold off. And then same on the upside. When you get 100% long on Wednesday the 8th, I think a gap like that kind of everyone pauses. I don't think whether you're fundamental technician, whatever your choice, your path to participating in markets, tough. But yeah, back above the 200-day. And in that manner is so tough to accept and be like, all right, we got to switch back. I'm not going to say, I don't even think it's a right or wrong thing. It's the rules of the process. Does it suck? Yeah. But it is when you get back involved. And we talk about this, right? And I know I've mentioned this at least a couple times in the client newsletter of the 200-day is still upward sloping. So you kind of have to err on the side that this does make its way higher eventually. And that is what we saw now. That I think, that I expected to be a V-bottom. No, I guess at this point, maybe I'm the stupid one because I don't expect the V-bottom. And that's all we get for 8 years. So maybe there's some soul searching I need to do over the weekend. But yeah, back up above. And it does feel like, I know you hear that word chase so much, right? Like no one wants to feel like they're chasing. And that's really hard after a 3% day. Because there is a chance you're going to look stupid. It's not like I don't even know if the Iran thing is figured out at this point. I don't know. But yeah, I mean, now if you sat and stared at it, you're even further up the creek.
Well, to your point, I mean, we're sitting 5% higher than that gap open on April 8th. If you sat there, and that's that cognitive dissonance, if you're active manager, trend follower, and maybe you're in macro, maybe you're a fundamentalist and you're like, oh man, this Strait of Hormuz thing, like we can't survive with this amount of oil uncertainty. Like we can't have that much and have the economy do well. But this goes back to markets are a future discounting mechanism. They know more than us. I get the backdrop. I get the Iran thing. And even as a technician, I get it, right? You're below, how many times we talked about 6,800, the 200-day, you get below that, sharp move, reversal higher. But if you just sat there, deer in headlights, that's tough, right? You've moved 5% higher from that point. And by many metrics from a lot of the data miners, I mean, it's one of the most historic moves in a 12-day period that we've ever had. And that's information too, though.
So price thrust, which leads me to ask, all right, so price is the most important. We get it. Price, we get paid in dollars. We didn't get paid in how many stocks are participating in the market. But has the participation over the last couple of weeks, is it solidifying the price move?
That's a great question. And that would be the one major, I'm going to call it a red flag at this point.
I think that's fair.
I'm a fan of what you've said in the past. There's no such thing as the market ever checking all the boxes. Sometimes there is, maybe 2017, low vol, markets participating, high correlation to the upside, broad participation, checking all the boxes. You rarely get that in a market. But to your question, and I know Scott Brown, a chartered market technician, highlighted that we had S&P reach a new high with only 12 stocks in the S&P 500.
That's crazy to me.
12 stocks in the S&P 500 reaching a new all-time high. And his point was we saw that in August of 2025. And I'll pause there because we've talked ad nauseum on here about just the sideways nature of this market since summer of 2025. And then the other periods mentioned on there are March of 2000 and April and July of 1999. And that had limited participation of matching the all-time high by the index by the underlying stocks. And we haven't had breakaway momentum. We haven't had back-to-back 80% upside days. We haven't had a Zwig breath thrust during this move, right? So that makes it a little bit different than off the tariff tantrum low, where we gapped over the 200-day, and that was matched by some of these breadth thrust expansion numbers. We haven't had that yet. Do have to put that in the thesis study category of like, that's interesting. But a question back to you is, would it be hard to get that breadth type number with what energy is doing? And here's where I'm going with this. I'm going to try to paint the picture. With the Iran backdrop, we had such a rapid move higher in oil and energy, and they've since pulled back during this move higher in the rest of equities. Is it even possible to get back-to-back 80% days, whereas wig breadth thrust with the energy part of the market just not there? It's pulling back in. It's a reversion to the other side, down to the mean. And so you wonder, is there breadth expansion? It's just you can't count the numbers like they used to be for this current market environment because of what energy is doing. Do you have thoughts on that?
I think it's a fair, I need to do some data digging. I think it's definitely a fair argument. I mean, how many 80% updates did we have in like a 2021?
So 2021, when we look at 80% up days, so, I mean, quite a few actually.
Oh, yeah, we did. Yeah, we did. Okay. See, and that's why you got to look at the data. I just know that was also a lower breadthy year.
Especially towards the back half of the year, for sure.
Yeah, we really, January and February, March pretty good, and then everything other, right? Then that's when the whole like Mag 7 thing started. Only 8, remember that? We heard that for 9 months. Oh, there's only 5 stocks. There's only 7 stocks carrying the market higher.
Which was true but not true.
It's true but not true. A lot of valuable lessons learned that year. Every 100%. Year produces valuable lessons, but...
Well, I think we're getting another one of those years. We're getting historic moves in a 12-day period.
We're up another... I mean, right now, right, we got 4 hours till the close, but... This is tough, Dave. If you are not... I mean, okay, so we had the Wednesday, the 8th gap, but then we also have had a gap on Tuesday, gaps today, and they're gapping and going.
Right.
So, yeah, you sit there.
As a technician, some of these, depending on what you're looking at, like semiconductors, for example, that in some ways looks like a breakaway gap, which is just the start of a move. And then you wonder, and when I say the term wonder, I mean it more from a thesis standpoint. You have a thesis, and then what are the things that are going to refute that thesis? And right now, one thesis out there for our team is this a 99-2000 period? We had Allbirds, a shoe company, this week say that they're pivoting into GPUs and being an AI compute, things that have held up well during that 7% correction, during the Iran backdrop, was semiconductors, was AI.
AI held up really well.
And data centers and space. And those are very risk on. And maybe we can make an argument for therapeutics and biotech in there.
Look at that DTCR.
Yeah. Are we saying, like, there is a thesis out there that this is a 99 scenario where the quote unquote bubble just becomes a bigger, I don't even like saying it like that, but like, the bubble just keeps going. You have 2 years of just outsized returns out of that area. Semiconductors, AI. I even throw in the fact the software flush could be overplayed, was overplayed.
Yeah, how are we looking over there? Is that bounced?
It has.
Okay. Yeah, look at that. Fail breakdown.
Mm-hmm.
Below 676 on IGV, 76, 77-ish.
And so you sit there and say, okay, what's the pain trade here? We've had pain already. Not if you're buy and hold, whatever. I'm not talking about that. I'm talking about whether you're a macro positioner, active manager, trend follower, the V-bottom scenario. Now what do? You're at all-time highs. You continue to move higher. An aggressive 12-day move without an 80% up day. That's a tough scenario because are you going to, Brian Lund had a good segment on this where do you anchor to the low from a psychological perspective, or should you be looking past that low, similar to the tariff tantrum? Like once the tariff thing passed, the true data came through. Same with Iran. Is there an argument to be made that this market is just getting back to its normal rate? And I think the two pain scenarios that stick out to me are, do we sit in a range above 7,000 on the S&P for a couple months, or do we just move another 8 to 10% higher and lock out people who are trying to get back in? Tough stuff.
Yeah. I do think at some point, and I think that if we use this most recent example, that some point probably should have been Thursday, April 9th. At some point, you do have to stop asking, why is it higher in the face of pick a headline? Not saying that that's what Brian, but back to our talk on if you didn't get involved, if you're not involved yet, if you're under allocated, you're approaching markets with through a non-technical lens. I wanted a correction on Thursday, April 9th. That would have made me feel a lot more comfortable. But then we sat there, Kevin and I sat there, and looks like we're doing this again. And we did it again. We got the V bottom.
Yeah, markets don't make people comfortable. That's not their job. And so do you have a process? You mentioned a rising 200-day, getting back above that. What other process do you know? Like if you're a macro fundamental person, what would you use to tell you game back on, right? Wayne's World, cars passed. It's time to get back involved. Time to get the car out of the garage and start participating again. It's only technical analysis that allows us to see that. If you're a macro person, I mean, because I get it. The Strait of Hormuz, oil transport, that whole narrative, I get it.
I mean, I think there's a lot of, I think if you are navigating markets based on news, kind of just your gut instinct that the coast is clear, I think that's really hard. And I do wonder, so let's say April 1st, you sent out a newsletter to clients. If you cut off an S&P chart on April 1st, it doesn't look very pretty. You were probably writing that letter at the end of March. We were at the lows. If you've been prepping your clients to also mentally shift, I don't know how that works. We don't have that type of communication with our clients. Well, we do send out monthly letters, but we're not. It's a little bit more matter of fact. This is getting really long-winded. I wonder if there's some hesitancy when you've just kind of also moved to a bearish stance with clients and you've communicated that to 2 weeks later shift back. So you just sent out this newsletter that has bearish tendencies, bearish undertones. We've broken support. We're below a 200-day, whatever it is. And then 2 weeks later, your clients are going to log into their client portal and they're going to be 100% allocated?
That's called being adaptive, Ian. But your point is valid. Like most are not able to have that type of agility and adaptability to say, oh, the information's changed. The previous thesis is now invalidated, right? Because that gap above a 200-day and clearing 6,800, which has been an important level for how long? That's hard. Completely agree with that.
It's tough news. It's tough news when it's delivered that way. 3.5% gap. That's a punch in the face. I mean, we did that. We sent out the ETF letter about, hey, allocated to T-bills. I mean,
Yeah, for sure.
I don't have any feelings about that because it's the strategy. But I'm willing to bet that that's hard. I mean, if you're going to send out a doom and gloom letter and then 2 weeks later be like, now we're fine. Yes, we can do that with our clients because they've been through a lot of that stuff with us. They are I don't want to use the word like we've trained our clients, but they get it.
Well, and I think if I can take the liberty of marrying this to some recent weather events in Wisconsin.
Yeah. What is going on up there?
So, early this week, tornado warnings, which I know people get confused between tornado watch and tornado warnings. Watch is possibility of tornado. Warning is we've seen a tornado. And in Wisconsin, we've had these storms going on, and we're going to have another batch going through tonight, that it can be the correct choice, even if it doesn't become fruitful, to cancel events. I'll give you an example. There was supposed to be a practice for one of the sports teams for the high school that I help, coach their team, with the backdrop of we had 15% chance of tornadoes. And when you're trying to protect 17 players and there's not really there's no basement in a high school, and so you cancel the event, but no actual tornado happens. Was that the wrong move? Probably not, because what's the risk if the 15% does happen? And it's the same with markets. Like, I don't know what the odds were of clearing back above a 200-day, but all I know is the process dictates when risk outweighs reward that you protect. And when that storm clears and nothing materializes, you get back involved, which is what we've done for our clients. What's interesting is my blind spot in all of this is we're pretty nimble, pretty agile and adaptive here, that we can change from zero participation to car out of the garage and foot on the gas pretty quickly. I don't know what that looks like for other firms. And so are other firms in a spot, or other investors even in a spot where, well, I can't possibly get in now.
Or it's buy and hold, so none of it matters.
That's true. But where buy and hold fails is another 22, 23 scenario, or a 2008, 2009 scenario.
We'll just worry about that when we come to that bridge, Dave.
But it is a extremely unique spot right here, right now, right? Because a midterm election year, and I think Ryan Dietrich shared this, and I could be getting that wrong, that mid-April is about the peak before a midterm election, before the market moves higher. So to paint that is like mid-April is a high. There's price corrective behavior into midterm elections, and then we move higher. The counter argument to that is the 6th year of a presidency term, which is what we're in for Trump.
And that's supposed to be good?
And that's stronger. That's typically a strong period of time. And so you have that juxtaposition against each other. And it's unique because obviously Trump wasn't back-to-back 8 years. It was, you had a pause in between there with an elderly robot. And so now you sit there and go, okay, how bullish is it if we are going into November midterm election time and the market's moved higher through that? That's extremely bullish, extremely. But I'm also open to the fact that another pain trade is we just hover between 7,000 and 7,200, correct back into the November low, and then move higher after November. It's another option. But I think you'd agree, Ian, and most of our listeners would too, that that's a tough scenario. Like if you're under allocated currently, where do you get in? How do you get involved in this? And if we get a volatility crush and the market just grinds higher, like imagine if the market just is like 0.2, 0.3%, down 0.2, up 0.4, down 0.2, up 0.3, and you just grind higher.
I think if you go to a weekly chart, I think this has really got to be it. I mean, you're taking it or you're betting that it fails. I say do it. I say do it as close to 7,000 as you can.
To manage risk.
Yeah,
for sure.
You got the weekly breakout. I know the last 2 weekly candles give that, like, oh my gosh, like you want me to like start buying stocks here again? The answer would be yes. Again, managing risk. At the end of the day, we are above 7,000.
Yeah, right. And there's more buyers willing to buy at that price than there was previously. And is it information that we didn't consolidate at 7,000? We just sliced through it like butter. And then the scenario enters, the thesis enters the picture of, is this aggressively higher? Which, man, I wonder how many investors that locks out psychologically. And if I can use a technical term, on a weekly basis, Ian, we're about to record 3 white soldiers. And I don't mean that from any type of racist type term, but these 3 candles, the last 3 weeks, that's 3 white soldiers. That's a classic technical bottoming process that the end of March low is it. It's in.
Yeah, a lot of European heritage in those candles.
Yeah, so I just appreciate the market so much because it's a humble pie making machine. It was appropriate to have risk off positioning below a 200-day, below 6,800, and how quickly that shifted. And I get it. People will want to marry whatever narrative they want to that. Oh, now things are good with Iran, et cetera, et cetera. I get that. And there's other things that we obviously should be paying attention to that we touched based upon previously, which is just how strong AI, data centers, semiconductors were. The 99-2000 thesis is alive and well. You get a shoe company saying they're going to be an AI firm now, Are we seeing a huge move happen right now?
Well, and here's what I ask, whether it's going to be this big AI semiconductor super cycle. We're probably already in the semiconductor super cycle. But you're a portfolio manager. You are an advisor. Even if it's just a normal uptrend and we don't give it any special name, do you want to sit back and say, oh, yeah, I think that's one of the biggest baseline things for me is I just don't really want to sit in front of a client and potentially have to say, I know we missed out on it. I didn't actually think the market would be that strong, or I didn't think it would move that quickly. I think like that's an actual legitimate fear of mine. I'm okay being slapped around. You know, not everything is a trend. I wish it was as a trend follower, but you get sideways periods. I would be sick to my stomach, and I don't use that as hyperbole. I would be sick to my stomach if the market ripped 20, 25% and my clients are looking at me and they're like, what happened? And I'm like, I didn't think that would happen. I thought the market would be worse. I thought it would be weaker.
Well, that's the power of technical analysis. It helps you get over that. And I really appreciate that vulnerability because it's an absolute truth and technical analysis helps you see when your reservations are wrong. And I think that's such a good insight into probably where a lot of advisors sit, a lot of investors sit, is how could this be happening? We're at war with Iran. We're pinching the supply of oil. Like, how could this be possible? Market doesn't care what you think. Doesn't care what I think.
Well, and so you mentioned earlier future discounting mechanism. To me, I think you really only have to go back to COVID for that. Like, how did that? Okay, so markets peaked late February, middle February, late February, middle-ish, like the 19th, wasn't it?
Sounds right. That is right. It's late February of 2020.
Yeah, so the 19th. I don't know why there's a gap down on the 24th. I mean, yeah, I guess there's a little bit, right? And then you're in the thick of it. Like now we get to end of March, 30 days later, and we've got death tolls on screens. Shouldn't leave your house. You shouldn't be, all the school, everyone's doing e-learning from school. You can't have Thanksgiving. You can't even be on the beach. Remember they were like, we all remember. We all experienced it. I don't need to go through everything that happened. So we are in the thick of it, and stocks start to rip higher. And by that summer, I was at the beach that summer.
Oh, super spreader. I was a super spreader too. Remember that?
I think, we went to the beach with friends in June, and we were at all-time highs by August. Again, at some point, you just got to stop asking why. You got to get on the horse and ride it. Other people are riding. Your competitors are riding.
Well, it's like anything else that's competitive is, do you really have time to think about why? You got to react. You got to match the competitive.
But that's so hard. I think it's very hard to not have a thesis first. You can have but
wasn't the market just basically discounting in at that time that COVID wasn't going to be as bad as we thought?
Exactly. And we know, right? We know that looking back, like, oh yeah, COVID, that was a huge nothing burger.
And the same thing, like tariff tantrum, nothing burger.
Iran. So now we have Iran. We've got a big question mark. I think the question mark is fading. I think we're getting our answer. We're above 7,000. Do we have another nothing burger on our hands? Massive amount of evidence says so. I like high beta low vol is confirming. So you do have some.
This isn't being led by staples. This isn't being led by utilities.
No, golly, utilities. Yeah, terrible.
It's being led
utilities. I can tell you that all the utilities that are acting well, they're all like Latin American utilities.
I love the point you're bringing up is just future discounting, and that the market knows more than you or me, anybody listening, which is a hard pill to swallow because we like to think we know things.
And I think that's it. I think you just said it best. I think people like to think that they know things. It sounds cool. It helps you fill out 5 to 6 paragraphs in a client newsletter. You sound educated at cocktail parties. It's almost easier. If you just tell yourself you know.
Oh yeah, and my kids hate it. My kids hate it when they say, well, why is this happening? I'll say more supply and demand or more demand than supply. And they just eyes roll. Because it's not fun. It's not sexy. It's not the TikTok video. It's not the, wow, you sound really articulate and smart. No, because I'm not. And it's why technical analysis has helped us and our firm so much, because the market does know more than me. And you're right. It's easier to have like an opinion and a smart talking point and all those things. The reality is that's not how the market operates. It often slaps you in the face and says, well, that little narrative that you created is absolutely wrong.
Maybe that's why God put me in this line of work, because he knew I was smart, but also just dumb enough where I'd be like, you know what? Let's just follow the trend.
Yeah. Yep. 100%.
This guy won't be using big words. I don't think Ian's got big words in him. Let's give him technical analysis.
Which I appreciate. It's good.
I mean, hey, you've sat in front of clients during a period we're not using TA. I've sat in front of clients during, why do we own this? And I don't have a good answer for you, Barbara. I don't
have a narrative.
Yeah, maybe that's it. Maybe that's better. I don't have a narrative.
It's just supplies, or demand's outpacing supply. It's in an uptrend. That's why we own it. And again, that's hard because I just said that in like 3 seconds. That is so much less interesting than a 3-minute explanation.
Well, yeah. Don't you want to show your expertise, Dave?
Pride is so insidious. There's a big word. Hey, I used a big word.
Maybe you're a CFA after all. Let's not hate on CFAs.
No, not at all. Not at all. But Ian, I think your point's valid. And it's actually why we do love that the Adaptive Select ETF supports this podcast, because it's not based on a narrative. It's based on a strategy. And I want to highlight them. The Adaptive Select ETF is listed on the New York Stock Exchange under ticker ADPV, which helps investors access to the most prevalent factors in markets, momentum, and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. What you will not find in that prospectus for ADPV is macro thoughts, price to earnings thoughts. It is strictly price-based behavior, and that's it. And for some, that's not exciting.
So I mentioned earlier, ETF did go to T-bills for 2 weeks. We're back in as of this Monday, past Monday. Any thoughts, comments, insights? I know we want to start talking a little bit about the actual ETF on the podcast. Anywhere you'd like to start?
I appreciate the fact that it's able to pivot this quickly.
I'm glad the 5-day got there. We talk about the gap, and I've whined about the gap a lot. The gap actually did help bring the 5-day up. Like in the manner that it happened mathematically, I kind of did like that part. I was like, all right, well, if we're going to do this, at least the ETF's getting back in.
And what Ian's highlighting there is the rules-based strategy of ADPV is the 5-day and the 200-day relationship on the last trading day of the week. And when the 5-day of the largest 500 stocks in the S&P 500 is above the 200-day moving average on a Friday, you participate the following Monday, and vice versa. And so I appreciate the nimbleness of, you can go from 2 weeks from protective to participating. I think that's a good thing. There's plenty of strategies that are just buy and hold out there, just indexing. I don't know what value that provides. And then there's other strategies out there that might be just a little slower. That's their prerogative. But for us, we'd like to be athletes and adaptive. And it's nice to see the ETF, but ADPV get back to participating. And we'll see. Now, as far as like what's notable and what it's picked up in its momentum rankings, I do wonder. It's got a couple energy names in here that...
Well, if we basically picked right up where we left off.
Right.
I mean, 2 weeks, you are not going to get a big, massive change in the rankings. It's not built, we didn't build a system to constantly have 25 brand new stocks up and down. So energy is still high. Those stocks are ranked high, right? The system, still sees, right? Intermediate to longer term measurements. So, right, energy is still going to be viewed from a price behavior perspective as being in a longer term relative uptrend.
And at the same time, it still owns strength, whether you're talking about like a SanDisk or an Intel or Amkor, which is a semiconductor.
Yeah, it's got some ROIV has held up well.
Yeah, so some therapeutics, right? Some like animal therapeutics, Elan, you mentioned ROIV. So it's interesting to watch what this strategy picks up from a momentum perspective.
A lot of this, really, this HR healthcare realty, which has actually been, I don't know, we'll see. Kind of really only the newer name that popped in there.
I don't want to give this isn't investment advice, but I do find it interesting how the momentum factor has picked up recently, kind of been dormant for 7 months. And ADPV is a momentum factored strategy. I'm going to be curious to see what the next 6 to 9 months look like if the market's moving higher, if momentum picks back up. Because really, the momentum factor until recently had been hibernating along with the market itself.
And a lot of that, I think, was the large and mega cap perspective, but also under the surface as well. Obviously, we have no mega cap exposure, a few other funds that are similar to ours that, they're picking from a much bigger basket than the S&P. So yeah, I think it will be really interesting. Always interesting to see where momentum does. But momentum is momenting right now, broadly as a factor.
And that's a good thing. That's a good thing from a markets move higher standpoint.
I think the dumping in energy is another sign that I think we're just back on track with where we were. Like if we were going higher, but energy was still holding up, I think that would be, I'm going to say red flag, orange flag, golden yellow. But I mean, we are dumping energy and we are back in the growth and the tech and not so much the communication stuff. You said Netflix got hit?
Yeah, Netflix got hit. But high beta versus low vol, one of your favorite relationships, new all-time highs. So we're buying high beta, we're buying semiconductors, AI. I mean, even crypto. I mean,
what's going on with Bitcoin? Are we done?
Could there be something in Bitcoin, crypto, and crypto mining? Could be.
You're kind of breaking a rate of trend here.
And you're broke above the volume weighted average price for Bitcoin going back to the early part of the year. I mean, that's quality. A lot of these moves in the broad indices and even Bitcoin, or that April 8th gap, it's now looking more and more like you're going to look back at that April 8th gap and say, wow, that was an important development. Because that gap was right over the point of control from the November low for a lot of indices, the volume weighted average price from January 2nd, the first day of the year, and we're above those. That's extremely bullish.
And that's the risk you take. If you don't consider that possibility, that 6, 9, 12 months, we could be talking about this like, holy crap. Yeah, you remember like that Wednesday morning in April, they just gapped it and I think it's a risk to not consider that. And I'm not saying, but like you have to position yourself. Again, it's an upper sloping 200-day. I think we peaked in August. Let's call it June, July 2022. Yeah, so June, July 2022. You had a downward sloping 200-day. I think it's a risk. It's tough, but I think you got to pull the trigger. And if you got to do it right, you got to do it now. That way, if you're wrong, right, don't pull the trigger at 7,500, 8,000. Got to pull the trigger as close to your line in the sand as possible.
And we're seeing international still participate. That's hugely indicative of risk on behavior. If we're buying Polish equities and seeing Europe do well, really hard to get negative on it. Do I wish we had a breath rust? I do. And maybe we still get it. And maybe we do. Maybe we struggle through summer. I don't know. But the gap above the 200-day and getting above 6,800 on the S&P and now recording all-time highs on daily and weekly basis, I think that puts a lot of people in a tough spot. And it makes you wonder if it's only going to get tougher because we're still talking about a volatility index at 17, the VIX at 17. And if they crush that down into the 13, 12, 11, you're talking about a grind higher that will never let you in, that locks you out. That's tough. Tough stuff. Anything else you want to highlight, Ian, before we wrap up this episode of the Weekly Trend?
We were off last week.
Last week recorded. It was Good Friday.
No,
we were off.
We did record. We were off Good Friday. No, I don't have anything. I was going to make a comment about how maybe the markets are bad. We'll have to just skip more episodes. Get them to turn around.
Yeah, that's right. If you skip
it is more fun. It's way more fun to talk about stocks when they're going up.
Yeah, sure. Everybody likes when the line's going up. Well, we appreciate everybody listening. Please share it with your family and friends. Repost it on your socials. Give us a high ranking on your platform of choice that lets us know we're on the right track. And Ian will do this again in a week.
Have a great weekend, everyone.